Welcome to another week of Taxes in Retirement Live. I am Andy Panko, owner of Tenant Financial. There it is. Thank you. Welcome. Today, I will be discussing tax-efficient portfolio withdrawal strategies. Super exciting, right? For those of you that have not yet fallen asleep after that blazing intro of a title. Yeah. All right. Before I get into it more, let me start with the dad jokes. I see we have comments are working. Hello, exclamation point. Cody, very good. Thank you. Ooh, very magical, like Disney. Hola. We're getting bilingual now. Defaults. Hola. ¿Qué pasó? Okay. So let me do the dad jokes real quick. I will start you with, why did the Clydesdale give the pony a glass of water? Because he was a little horse. Tiny little horse. A termite walks into a bar and asks, is the bartender here? As in, is the wood soft, tender? And finally, last night I dreamt I was drowning in an ocean made of orange soda. It took me a while to work out it was just a fantasy. You know, Fanta has like pineapple soda and stuff too. Who would have thunk it? I guess whatever color and sugar combination you want, you can have soda. So anyway, that's dad jokes. Let me hit you with the disclosure quick. Here we go. This video is only general explanations and education. It is not specific tax, legal, or investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor, which I am not. For you all members in the group, I'm just some random guy here talking about tax-efficient retirement stuff. Do not take anything I say as advice to you or anyone else for that matter, just general hints and education. Cool. So tonight, again, tax-efficient withdrawal strategies. When I was thinking about how to say this, what to do, I realized I had to kind of step back some and discuss withdrawal strategies in general, which I'll do. And there's a few things we'll talk about. So first, I'll go through some of the more common withdrawal strategies and then get into how to make them tax efficient. Now, keep in mind, tonight's discussion is just in regards to whatever portfolio you have and money you need to take from it. We'll be talking about that. There's going to be other considerations for like Social Security and pensions. They're not portfolio income, but they're income nonetheless, and they're generally taxable to some extent. And tonight's conversation is going to really depend. There's some people who are in a great position such that their Social Security and pension, if they have one, covers all and potentially even then some of their anticipated expenses in retirement. Great position to be in. If you are in that position, whatever portfolio you have, you don't really need. Now, yes, there could be long-term care down the road or other major purchases you want to make or whatever, but just day-to-day spending, month to month, year to year, if you have more Social Security, pension, and or annuity income than you have in expenses, portfolio withdrawals don't really matter. It's just this pot of money that's there for fun stuff, for emergencies, for unforeseen stuff, whatever. So you don't really have to, I don't want to say don't pay attention to tonight's topic, but this is just for people who do want or need to actually take money out of their portfolio, which is most people, practically in retirement is most people. But there are some people where all their income needs are met by Social Security, pension, and or annuities, in which case portfolio is just kind of there. Just take it as you need it, et cetera. So you don't have to worry about the strategy here. With that said, there are a lot of, this is one of the more technical things, one of the more complicated, kind of broader topics that has a lot of moving parts going into it. So, if things seem a little complicated or difficult or not quite making sense, I'll try my best. But this is, I don't want to say it's the capstone of everything we do in this group, but it does involve a lot of stuff and assumptions and knowledge that goes into ultimately withdrawing from a portfolio. And there's no single right way to do it. As we'll discuss, there's lots of it depends. And, Cody joked we should do a drinking game on it depends. This is probably one of the best nights, either this or some sort of investing topic is probably one of the best nights to do it depends drinking game. Because as you'll see, there's lots of different ways this can go. There is no single best or right way. Part of it's personal preference. Part of it's there's so many other moving pieces between the financial markets, tax legislation, whatever. Now, and this is what makes retirement planning, retirement income planning so difficult. It'd be real easy if you knew with certainty when you were going to die, if you knew to the penny how much money you would need every year for the rest of your life, whether that's 10, 20, 30, or 40 years in the future, and if you knew exactly what interest rates were going to do and what the stock market was going to do and when they were going to do it. If you told me those things, this job would be super, super simple. And I can give you a rock solid, no bones about it retirement income plan with 100% certainty. Well, guess what? You don't know any of those four things. Or if you maybe you have some idea, and that's the whole point of what we do. What I do is to try to put as much, planning and assumptions and educated guessing and defensible justification to all those things we just discussed and plan accordingly. But realize life happens for good, for bad, for indifferent. Things are going to change. Whether you're 10 or whether you're 80, things will happen. It doesn't mean you shouldn't plan. It's like flying a plane. Just because weather's going to change, there's going to be turbulence, whatever. You don't say, forget it, I'll just wing the whole thing. No, absolutely not. You still plan accordingly, but realize the plan will change, right? You're going to get curveballs along the way. Things are going to happen. So you have to stay flexible, which is also what makes difficult, like trying to nail down an exact income withdrawal strategy. Is there are going to be so many variables throughout life. Even in retirement, all this stuff is a moving target, honestly. There's some ways you can kind of take a lot of the guesswork out. Like at one extreme, if you wanted to take every single dollar you had and just buy annuities, then with certainty what your paycheck's going to be every month for the rest of your life. What your income's going to be. That's an expensive way to go about it. Annuities, there's lots of flavors, but it costs a lot of money to get yourself a lot of monthly payment in annuity, especially now with interest rates so low. So I'm kind of rambling there, but the point is there's lots of variables to this, which means this whole income withdrawal thing, you have to stay flexible because it will change along the way, and just kind of adapt with it as life happens, as financial markets do what they do, as tax legislation inevitably changes. All right, someone's already tipsy. Yeah, I know, because I'm all sorts of weird words coming out of my mouth right now. It's intoxicating and not necessarily in a good way. Okay, let's get to it. I will bring up my slides here that I made. So let's first start with some of the common portfolio withdrawal options. This isn't tax efficiency yet. This is just, like I said, I felt the need to run through what the different withdrawal strategies are for a little bit before we get into doing stuff tax efficiently. All right, here we go. Okay. So again, this is on top of, you already have your Social Security is what it is. You already have a pension, let's say, may or may not be turned down, but whatever, that's going to be whatever it's going to be. This is just for the investable portfolio you have. This is different ways to take money out of it. So let's start with the most simple. First is just completely fixed. You take out, for example, $3,000 a month, boom. You don't increase, you don't decrease. It's on recurring, ACH transfer out of your account, out of your investment account into your checking account or whatever. Maybe you have tax withheld, maybe you don't. That's a whole different story. But the point is, you just take out simply $3,000 a month or whatever amount. There's not a lot of thought to it. I mean, maybe the thought is like you realize you need X amount of dollars to cover your bills each month, so you pull out, so some amount of money. But the point is, it's static over time. Maybe at some point you change it, but otherwise it just kind of runs until you decide to do it differently. The opposite is completely variable. You have no rhyme or reason or strategy. You just simply take money out whenever you need it. Both these two, the fixed and the variable, obviously have downsides. The fixed one, if there's a horrendous string of market returns in your portfolio, drop because stocks and bonds go down, yet you keep taking out the same amount, that can be dangerous. You can be depleting your portfolio significantly faster, because even in down times, you keep pulling out the same amount of money, so that there's going to be less shares and less bonds to eventually rebound when things do turn around off their dip. Completely variable, sort of same thing. If you're not paying attention to how much money you have, how much you're taking out, how big your portfolio is or isn't as financial markets move, there is no plan. Now, if you have a $10 million portfolio and you're only taking out $30,000-$40,000 a year, you're not going to spend that down. Even if you don't invest it in anything, it's just sitting in cash, you're not going to run out of money, taking out 20-30 grand a year from a $10 million portfolio. But in most cases, you have $1 million, $2 million bucks, or less, $500,000, whatever. You do need to pay attention to how much you're taking out versus how much you have. That then one of the sort of widely accepted, very basic rules of thumb. That this isn't exact science. This is rule of thumb, the 4% rule. So what is this? You've probably heard of this. I'm just looking at the comments here. So here's a good one. So am I talking about IRA portfolio or just non-IRA, meaning brokerage accounts, et cetera, or Roth? So this is anything. As of for now, so far, whoever this poster is, I'm not talking about any tax impacts at all. This is simply gross withdrawals, whether you have $100,000 in a regular brokerage account or $100,000 in an IRA or $100,000 in a Roth. If you take out $1,000, you're taking 1,000 out of 100,000 just the same. We're not yet talking about the tax and the net amount you keep. It's just simply gross distributions from a portfolio, whether it's IRA, regular brokerage, Roth, HSA. So still talking pretty generically for now, but good question though. All right, so the 4% rule, this now starts to put some historically tested parameters around how much is safe to withdraw from a given portfolio size. So let's keep the math simple. Let's assume you're starting retirement, and I've had separate topics and separate videos on 4% rule, so I don't want to belabor this too much. I'll just take questions at the end, obviously, but I'll just touch on a high level what it is now. If you're interested in more details, check out my other stuff on my YouTube channel, Retirement Planning Demystified. There's all sorts of videos about this, or not all sorts, but multiple at least. So 4% rule. So let's say you're 65, you retire, you have $1 million of portfolio, and you want to know how much could I take out from that $1 million and take out going forward for the rest of my life with ideally minimal to negligible chance of that portfolio depleting. This is where the 4% rule comes into play. So if you have $1 million portfolio, it says you can take out 4% the first year, so $40,000. And then every year thereafter, you would increase the amount of your withdrawal by however much inflation there was during the year. So let's back up quickly. So you have $1 million at the start of retirement. This says you can take out $40,000 in your first year. That's 4%. And let's assume there's 1% inflation over the year. So the next year you would take out $40,400, if I did the math right. 1% of 40,000 sounds right. So $40,400 is what you take out in year two. And if there's again 1% inflation for that year, you would then take out $40,800 in a little, et cetera. So the amount of money you're taking out scales up a little bit every year from its $40,000 starting point, goes up a little bit with inflation. So whether your portfolio goes up, goes down, whatever, it doesn't matter. The amount you take out was keyed off the starting balance when you first started distributions, and then goes up every year for inflation, and that's it. Now, historically tested, this rule says that under any sort of historical circumstances that happened, including the Great Depression, a portfolio would not deplete over the course of 30 years if you only took out this original 4% plus, increase each year for inflation. And that also assumes your portfolio is like half stocks, half bonds. It can be slightly more, slightly less, but and it only assumes it lasts about 30 years. If you're retiring when you're 20 and you need a portfolio to last, potentially 80 years, don't do this. Chances are it may work, but that's a long time to be taking money out. If there is a real bad string of market returns, you could be in trouble. So 4% rule, real good rule of thumb, good back of the envelope litmus test. It's not the end all be all, again, because it makes a lot of assumptions. It's based on history. And as we all know, the past is not indicative, or the past returns are no guarantee of future results, et cetera. But it's a starting point. Just to let you know, if you have $1 million, you can roughly think about, okay, I can safely take out about 40 grand a year, plus a little more every year, with, historically speaking, not high chances or really low chances of running out of money over the course of about 30 years. All right, I'll leave that one there for now. And the other one, so this is sort of an adaptation of the 4% rule. This is guardrails. This helps you further minimize or prevent actually your portfolio from depleting. And here's why. So you start with some basic amount, 4, 5, 6%, whatever it is. And basically, if the market does well and your portfolio goes up in value, then you can take out a little more. If your portfolio goes down in value over time, you got to take out less. So obviously, if you're always adjusting how much you're taking out based on how much portfolio you have, you'll never run out because you're always, taking a relatively small portion, 4, 5, 6%, whatever, of how much portfolio there is. So that's the good side. That's the good thing. Won't run out. The bad thing is your withdrawal and therefore potentially your ability to spend is completely at the whims of the market. Some people don't like the idea of, if I'm on retirement, I don't want to have to spend less simply because the stock market's having a bad few years. So that's sort of the downside of this guardrail idea. Pros and cons to everything. And my overarching comment to all these is there is no right answer, like I said. These are all sort of rules of thumb. There's different approaches to have. And they're all, some of these are too sort of mechanized, too formal. In reality, life's going to happen and your spending needs are going to go along with it. Yes, you should have a plan. Yes, you should not just, freely blow through your money. Life's going to happen. Your spending is going to be variable. Your income needs are going to be variable. Like this year, last year with the pandemic, who would have thought? Most people, I would venture to say, their spending went significantly down from what it was prior, simply because you couldn't travel, you couldn't go out as much, you couldn't, be doing as many things on a discretionary fund basis. So expenses dropped a lot. So don't get too hung up on there needs to be one single mathematical, neatly quantifiable withdrawal strategy. No, you can use a combination. You can whatever. The gist is, don't spend more than you should. Now, how much do you know how much you should spend? That's the tough one, right? Early in retirement, when you're of healthy body and mind, and you're going to be doing discretionary stuff, yeah, you probably should be spending more then on travel, on fun things. And then as the body and or mind start to slow down, the discretionary expenses kind of tail off, right? You're not doing these super adventurous backpacking trips anymore, or you're not doing really aggressive physical hobbies. So your spending will probably decline. But then healthcare expenses may tick up. Some people they do, some people they don't. But oftentimes, don't be surprised that it is okay to spend some more early on in retirement when you're young and vibrant and can do stuff. But realize your spending will probably or should have to cut back a little bit as sort of retirement progresses. Unless you have such a big nest egg, it doesn't matter. But otherwise, for most people, just using like 4% rule as an example, don't get too hung up on, oh my God, I can only take out 4% and that's it. No, maybe do 5, 6% the first few years, but realize at some point you're gonna have to make up for that by sort of like, curtailing it somewhere down the road. So my long-winded way of saying is, don't get too hung up on any of these as the end all be all of how you're supposed to take money out of your portfolio. Okay, questions. Here's a real good one. Anyone else having trouble spending more after a lifetime of saving? Whoever posted this, that's a common problem that I hear, that I read, that I see. And yeah, it's sort of human nature. You spent 40 years, if not more, earning, accumulating, saving, building. You have this nest egg that kind of feels like it's an extension of yourself, almost like it's a child. Like you've been nurturing it and taking care of it and watching it grow. And then you stop working, and guess what? Now you're taken out of it. So it's not only are you no longer contributing, but you're also taking out. So it's hard to watch that drop. And like I said before, the concerning thing is you don't know when you're going to die. You don't know what the markets are going to do. You don't know what taxes are going to do. So there is always some element of variability. Again, unless you have such a huge nest egg relative to your expenses that it doesn't matter. That's why in putting together an income plan, it's good to have like a foundation, a bedrock of lifetime income you can't outlive. Social Security, pension if you have it, potentially consider some annuities. At a minimum, have enough guaranteed lifetime income to cover your necessary expenses you anticipate having throughout retirement, so that even if and when your portfolio ever depletes, guess what? You're not completely destitute. You still have Social Security still there. You still have pension. If you have an annuity income, that's there. So that will still be there, throwing off income for you for the rest of your life to cover at least the basics. But yeah, good question. Good observation here. Totally different mindset. Yes. Yeah. Now I haven't lived it. I'm 43. I'm still in the middle of my earning years, so I have a ways to go. But yes, I'm aware of the phenomenon, and I see it firsthand with people. I can completely understand how it's a difficult mindset, but obviously, I haven't been there, so people may not. It's easy for me to say it. It's another thing to actually live it firsthand. But yes, I fully appreciate the mindset change of going from accumulating to decumulating. Okay, let me chug on. Next, so bucket strategy. You're probably wondering what this is. So a lot of you have presumably heard of it, and it's not a withdrawal strategy per se. I guess it is. It's more of a way to segment different buckets of money for certain times, when you based on when you think you're going to need to use that money. So there's generally 3 buckets, and I'll walk through this first, and it'll sort of make more sense as I get to the end of it. So think about it this way: you have 3 buckets. You start with bucket 1. Any withdrawals you're going to need to make in the next 2 to 3 years. Now, this is variable. Some people only do 1 year. Some people do potentially up to 5 years. But the point is, your near-term spending need or your near-term withdrawal needs, and I'm calling it roughly 2 to 3 years. You don't want that money at risk of dropping in value or getting cut in half because the stock market has, a bad couple of years or whatever. So basically, this is all going to be as safe as possible, effectively high yield savings accounts, CDs, other short-term stable things like that. They're not going to give you much interest, but you don't have this bucket for massive gains in returns. You have it for stability. You have it for certainty. It's there when you need it because you're going to need to tap this money in the next couple of years. Now, keep in mind, this is above and beyond your other income sources, right? So going back to my first comment when we started, some people are in a position where they have so much Social Security and pension that it covers all their anticipated needs. If you're one of those people, kind of disregard all this withdrawal strategy stuff because you're basically only tapping your portfolio whenever you have a big vacation or some other big expense or something like that, because you have these paychecks showing up every month covering all your needs. This is just, so let's assume, super quick example, you have $60,000 of pension and Social Security coming in, and you have $100,000 of total expense needs. So you're going to have to pull $40,000 from somewhere. This $40,000 is what's going to be coming out of your portfolio. That's what we're talking about tonight. Like how and where do you get this $40,000? So using the bucket example, let's say 2 to 3 years of needing to pull out $40,000 from your portfolio. Do the math. That's $80,000 to $120,000. So your bucket 1 in that case would be approximately $80,000 to $120,000, and it should be super safe cash or cash equivalent stuff. Bucket 2. So this is now, so bucket 1 is the next few years of spending. Bucket 2 picks up the spending needs where bucket 1 leaves off. So this is anywhere from 2 to approximately 8 years out. And again, there's no exact science how many years these buckets need to encompass. I'm putting roughly 2 to 8 years. In my mind, it's bucket 1 goes about 2 years, maybe 3. Bucket 2 goes from where that stops to 5, maybe 6 years. Some people who are super conservative, go closer to 10 years. So that's why I put bucket 2 covers spending from or income needs from years 2 to 8. So because this is longer term money, it can be invested less conservatively than just cash. Because again, cash isn't going to earn you much interest, but it's not going to drop in principal value. Bucket 2, you can take a little more risk to try to tweak out a little more return, hopefully above and beyond the 0.5% interest you can get in a high yield savings account. So bucket 2 is typically like bonds. Bonds, there's all sorts of types of bonds, and I don't want to get too into that. I did a whole separate topic on bonds, I don't know, a couple months ago maybe. Bonds can hopefully squeak you out, a few percent interest per year, maybe more, depending on the year and the type of bonds. But they're not going to drop 20, 30% in value like stocks may. So this bucket 2 is a little riskier, but still far from like crazy risky. And then finally, bucket 3, this is for all of your spending needs or all of your withdrawal needs, I should say, beyond where bucket 2 goes. So this is for years 8, 10 and beyond. This is bucket 3, and this is going to be your higher growth, riskier stuff like stocks. Stocks have really nasty years. Like at the peak of the financial crisis in 08 or 09, stocks were down 50 to 60% from their pre-crisis highs, right? But they came back and then some since then. And so, if you can let that money sit for 7, 8, 10 years or more, it should come back. I can't guarantee it will. Obviously, who knows? The world could end and none of this matters. But over the course of the better part of 10 years or longer, a well-diversified stock portfolio should grow and do well. But yes, there will be nastiness along the way. We don't know when or how much. But anyway, so you don't want your near-term spending needs to be at the risk of potentially dropping 50%, which is why you don't have stocks in your bucket one. Stocks are out in that further bucket. That's the long-term growth bucket. Good so far. Let me just stop and take some questions here. Okay. So that's buckets at a high level. Yep. So this person summed it up neatly. It's just near-term, medium-term, and long-term spending. And again, it's not really spending, it's withdrawals. Because again, mind you, if you have lots of Social Security, pension, or annuity income, you may not have much. Your spending could still be high, but your need to withdraw from portfolios could be low because you have so much Social Security or pension. This bucketing is really just withdrawals, how you structure your withdrawals. Because again, your Social Security, pension, they're there. They're always going to be there for you. I say that with an asterisk. Things could change, but they should typically be there, or most of it at least will be there for the rest of your life. Good comment, yeah. Bucket one, even if you already have a 6-month emergency fund and liquid high yield savings accounts. So depends. If you, again, this is also in addition to your other guaranteed sources of income, Social Security, pensions, what have you. 6 months may not be enough. If there's a multi-year craziness in the markets where both stocks and bonds are down for some reason. Now that'd be hard to do, but it's possible. 6 months may not be enough to let the ugliness in the markets rebound and start to come back. So you don't want to be forced to withdraw. You don't want to be forced to sell investments when they're down. Because if you do, you're then going to miss the rebound. You'll have less stuff to rebound when the rebound eventually happens. So 6 months may not be enough for a bucket one. I'd say a year at a minimum. More than 3 years is probably too much. As for what's right, it's up to you. Honestly, it's a function of your risk tolerance and things like that. So there's no mathematically right answer to say bucket one needs to be 2 years. It's kind of I'd say at least 6. Ideally at least a year, up to 3 years if you're a fairly conservative person. Okay, what's this? Yep. So short-term income needs have an investment objective of stability and liquidity, though it is often tempting to invest everything in equities when the market has been bullish in recent past. Cody, yeah, exactly. And like right now, the stocks have been running up and running up and running up. So it's hard to look at your cash that's getting 0.5%. It's hard to look at your bonds that are flat-ish, maybe getting a couple percent per year, and be like, oh, why can't I put this in stocks? Well, guess what? The second there's a downturn and stocks drop 20%, that's why. You'll be thankful you didn't have everything plowed into stocks at that point. So it's hard to have the conviction to sit and just like leave money, I don't want to say on the sidelines, but have your cash and bonds not do much when you see stocks going up so much, but there's a reason. Because if March happens and stocks drop 30%, you don't want your short-term money, your short-term income needs to drop by 30% because all of your money was in risky stock stuff. Okay. Man, a lot of questions already. Okay, just trying to see what we got here. First bucket. For the first bucket, any better place than a money market or CD, which pays crap these days? Crap is a technical term, and yeah, it's pretty accurate. Frankly, no. The purpose of bucket one is safety/stability, meaning you don't want it to drop in value in principle at all, and liquidity. You want and need it to be there when you need it. High yield savings account, complete liquidity. You can take the money out in a day. CDs, a little less. Certificate deposit, you may need to commit to 6 months or a year. But even if you have to break it early, not the end of the world. The only penalty is you give up some interest, some or all of the interest you earned. You don't lose principal in a CD. So CD is an option, but CD rates aren't great either. Above and beyond that, no. If you have access to a stable value fund, like in an employer 401k plan, there you can maybe get 2 to 3%. That's an option, but those are only accessible in large institutional plans like 401ks, 403bs. There is no stable value fund in the retail world, unfortunately. The only other option are some short-term, what's called multi-year guaranteed annuities. It's basically a CD from an insurance company, but you have to commit for like a year, 2 years, 3 years. And there are, unlike CDs, there are early withdrawal penalties that will eat into your principal. So you don't want to do that either for this super short-term bucket needs, because if you have to tap it in a year, and guess what, you're locked up in a 2-year annuity, you're going to lose some money, and that defeats the purpose of why you have bucket one. So unfortunately, no, there's really not better options out there other than maybe a stable value fund if you have access to one through an employer plan or something. All right, here's a good one. Many in the current markets have not seen the 80s and the crash of the 2000s. It's not only an upward curve. That's right. It's easy to get caught up in recent history. So I didn't really start investing until the late 90s when I was in college, and I got caught up in the tech boom. I didn't have a lot of money. I had a couple $1,000 in a brokerage account, and I was making $20, $30 a day. I was like, man, this is awesome. And guess what? The party ended in April of 2000, I think, was when things finally started to tail off. And then it was a bad few years. 2000, 2001, 2002 were down years. So that's a bad string, right? If you invested all in stocks, you wouldn't have been happy. So there's a reason why you have diversification. Diversification means always having to say you're sorry for some reason. Because when times are good and stocks are ripping, you have to say sorry because your returns could have been better had you not been held back by having some money in cash and bonds. So you have to be sorry for not performing as well. And then on the downside, when stocks eventually throw up, you have to say sorry because oops, your stocks did drop, so your whole portfolio came down. But at least you have this stable part here, the cash and bonds, that didn't drop so much. So it's impossible if you know with certainty when things are going to do, go up, go down. This would be easy, but no one knows that. So you kind of have to hedge. You have to have a diversified portfolio, and you get a little bit of everything, protection on the downside and gains on the upside. Okay, let me just move on quickly here, back to these buckets. So now you have these buckets. Bucket one is only a couple years. Bucket two is the next few years, and then bucket three is all the years beyond that. Well, what happens now when you're 1-2 years into it and your bucket one depletes? Now what do? Well, you refill these things along the way. Basically, you take from bucket three to refill bucket two, and then you take from bucket two to refill bucket one, like this. Ready? Wait for it. Bucket three fills bucket two. Bucket two fills bucket one. How about those graphics? Cutting edge stuff here. Now, hold that thought. Okay. So that you always have this rolling replenishment of your bucket, so that you always have this rolling like 2 years worth of cash in bucket one. And then you have this rolling 2 to 5 or 6 year out spending needs or withdrawal needs in bonds in bucket two. And then, bucket three is your stocks that are always kind of out there in the distance. And again, so even if stocks have a really bad few years, so what? You're not touching that bucket for 5 years plus, so you can let your stocks do their craziness and eventually rebound. Your short buckets are the ones where you have safety, stability, some certainty of what's going to be there and when. Now, what's my thoughts on the bucket strategy? I agree with the idea, the segmenting your spending, but it's real technical and cumbersome to implement, a regimented formal bucket, because you have to have 3 different accounts. And then you have to every year, systematically pull from 3 to replenish 2 to replenish 1, et cetera, et cetera. So there's a lot of implementation. And guess what? A typical, I use 60-40 as an example, whether it's 60-40, 70-30, 50-50, whatever, it doesn't matter. A balanced stock to bond portfolio inherently already has buckets, and this replenishment of bucket idea if you rebalance the accounts regularly. So and I'll explain what I mean by this. Having a formal bucket strategy is really nothing more than just visually, visual depiction of how your portfolio's allocation to stocks, bonds, and cash is going to be withdrawn in what order. So think about it this way. You have a portfolio that's 60% stocks, 40% bonds. Let's just assume it's $1 million portfolio to keep the math even. You have $400,000 in cash and bonds, and you have $600,000 in stocks. If your withdrawal needs are 50 grand a year, that $400,000 cash and bond bucket covers 8 years of withdrawal needs. There's your bucket one, bucket two. So within that 40%, you'll have, let's call it 100 grand in cash. So that's 2 years of your cash needs. That's your bucket one. And then you have 300 grand in the bonds. That's your bucket two. That covers your next 6 years of pulling 50 grand out. And then you have your 600 grand in stocks. That's your bucket three, your far out stuff. Now, why do I say that rebalancing does bucket replenishing? Because if you have a 60-40, here's your 60, here's your 40, and stocks do well like they've been doing, your stocks keep growing relative to your bonds such that you're now 65-35 maybe. And so you have to go in, sell some of your stocks to buy some of your bonds, to bring down the stocks, to bring up the bonds a little bit, to get stuff back to 60-40. In doing so, in rebalancing, you're forcing yourself to sell stocks at their high, to buy bonds at their low. Well, guess what? That's using bucket three to replenish bucket two. That rebalancing does this replenishing. And on the downside, when stocks drop, so you start with 60-40, stocks drop, so your stock is now 55 of your portfolio and your bonds are 45, let's say. Well, then what do? Well, then you actually sell some bonds to buy some stock to get you back to 60-40. So this rebalancing forces you to buy high. So no, you don't want to do that. That's the opposite. To buy low, sell high, to bring things back in line. Now, what you may be thinking is, okay, well, when stocks drop, you're taking from your bucket one, bucket two to buy more bucket three. Yes. So there's sort of a limit to this. You have to be cognizant of, what are your withdrawal needs? How many years are still covered by bucket two? So you don't kind of overdo it with this rebalancing. So it kind of takes some work to pay attention to how much is in each bucket and how much you're rebalancing. But the point is, whether you formally slice and dice your portfolio into this account's bucket one, this account's bucket two, this is bucket three, or you just have one big fat happy portfolio that's 60-40, you can view that as having buckets within it. So anyway, point is, you don't need to go so far as to overly systematize all this and do this regimented bucket setup. A well-balanced, well allocated, regularly rebalanced 60-40 or 50-50 or 70-30 stock to bond has buckets in it because it has different, this is stock, this is bonds, this is cash. So point is, I don't think it's overkill to do an actual like bucket, because a typical portfolio already has its buckets in it inherently. Anyway, I'll stop there with the buckets. Okay, what's next? All right, so we're about to get into the actual tax efficiency of stuff. We're only 40 minutes in before starting. Not too bad, I guess. And I'll get back to, let me just check questions quickly. Okay, some comments. What's my thoughts on a 2-bucket approach with cash in bucket one and a balanced fund in bucket 2 or 3? Yeah, great point. And coincidentally, maybe not coincidence, but just like I talked about, yes. So true cash is your bucket one. Bucket two, a simple 60-40 fund, like a balanced fund, which is simply one mutual fund that has X amount in stock, X amount in bond. Boom, there you go. There's your 2 buckets, right? That works just as well. Again, bucketing is just a visual depiction of the time in which you'll take withdrawals out of which portion of your portfolio. But yes, this does it just fine. As long as you have some cash, you have some bonds, you have some stock, there's your buckets basically. So yeah, good observation. Any comments regarding alternative to bucket strategy? Basic needs, contingency needs, discretionary, legacy. Yeah, this is a higher order question here, and this is where this retirement planning, this income planning isn't as scientific or mathematical as people try to force it to be. Now, yes, you have to start with some sort of quantified approach to all this stuff, but at the end of the day, things change, contingencies. So by contingency, I assume you're meaning like emergency fund. Now, if you have bucket one that covers 2 to 3 years, you can consider that your contingency, unless you're planning a contingency that's like, $1 million or something, then obviously that'd be a massively large bucket one. But I guess I would need to know specifically what you're getting at and kind of what the differences are here. But yeah, the gist is with bucketing withdrawals, basically, you don't want to be selling assets when they're beaten up in price. So, you want cash for your near-term needs, relatively more stable, but slightly higher growth for your medium term, and then like the high growth, riskier stuff for your long term. I don't know if that answered your question, but hopefully it touched on some of what you were looking to find out. How often do you rebalance between buckets? There's no great answer to this. I mean, whatever you do it routinely. I'd say, don't market time. Don't wait until you think the market's high or market's low to do stuff. Set a calendar and stick to it. Like for people I work with, we rebalance quarterly. Done. I don't guess. I don't feel like things are overvalued, so I'm going to try to sell some now while they're hot. No. Take the emotion out of it. Take the guesswork out of it. Come up with a schedule. Stick to it. Yeah, that's kind of it's the best way you can do. Take all the emotion out of it. Rebalancing anything more than monthly is probably a waste of time and too much work. I'd say at a minimum annually, you want to rebalance, refill, whatever. Anywhere from quarterly to annually feels right. I do quarterly. It's not necessarily good or bad. Some people do twice a year, but I don't know. Quarterly feels like the right answer to me. Monthly is too often and too much. It's just not worth it. The incremental gains, if any, or benefit, it's not worth the extra time in my opinion. But quarterly feels right. So that's what I do. If you have a brokerage account, a Roth, and a regular, would you have buckets in each account? Yeah, this is what makes the bucket strategy difficult. Is the bucketing doesn't discuss account types. It's just simply cash for near term, bonds for medium term, and equities for long term spending needs. This is how the buckets get even further complicated. Is okay, I have 4 different account types: brokerage, IRA, Roth, HSA. Which one do I take from? That's what we're going to touch on in next in a little bit with the tax efficiency of stuff. So it's kind of like this mosaic approach. You have this bucketing idea in mind, and then we're going to discuss which account types you take from and why, trying to meld them together into a cohesive strategy. That's where things get kind of convoluted and all over the place. But we'll discuss that. Isn't this why it's a good idea to wait on claiming Social Security until 70, since that gives you the biggest safe amount of money flowing in? Yeah, good point. Maximize Social Security. That's the foundation of most good retirement income plans is Social Security. Take advantage of it. It's one of the best annuities you can buy. And by buy, I mean like delay. The cost of delaying is getting you higher payments. From a traditional annuity perspective, Social Security is the best annuity out there. How far before retirement should you start setting up buckets? Well, I mean, maybe someone else addressed this down the row here, but I don't like the bucket idea. I think it's unnecessarily strict and processed and whatever. I think just having a well-diversified portfolio that you rebalance regularly, that's all you really need, in my opinion. Okay, so Vanguard Wellesley, sorry, but I do not discuss specific investments. That crosses a line. I'm not blaming you, whoever this is, but you'll notice I'd never discuss any specific funds by name or specific securities by name, because that starts hinging on me giving investment advice, and do not do that in public forums. But good question. Okay, let me. Ooh, geez, Louise. All right, yeah, I'm gonna have to stop with the questions for now. I'll get back to as many as I can at the end. It's already 8:45. Wow. Okay, we've got a live one tonight. All right, let me keep going. So, traditional withdrawal logic is now. This isn't. I don't want to say it's not about tax efficiency yet, but if you look up like the order of withdrawals from portfolios, it's going to tell you this in almost all cases. First, you withdraw your cash until it's depleted. Then you withdraw your regular taxable brokerage accounts until they're depleted. Then you start tapping your tax deferred accounts traditional IRAs, 401ks until they're depleted. And then finally, you save the Roth for last, and then you start pulling from Roth again. And the reasoning behind that is that this looks at the maximizing the growth, the net growth of all these things net of current taxes. So let me explain what I mean. So cash obviously earns the smallest total return all in. Today you can get 0.5% interest in a high yield savings account or something. Take away tax, and if your tax is 20%, now you have should have come up with it, but now you have 0.4%. So net of taxes, you're only making net 0.4% return or interest on your cash. So that's not very low. So use that first. Let your other stuff grow in the background, because number two, brokerage accounts. A well-invested brokerage account should be earning you more on average than the paltry amount of interest you can get on cash. Now, the reason why traditional logic is take brokerage assets first is that they typically use this in the context of bonds. Interest you get on most bonds, other than municipal bonds, separate topic, interest you get on most bonds is taxable in the year you receive it. And because it's taxable as ordinary income, the net return from that is going to be, if you get 5% interest and you have 20% tax, you're only getting 4% interest. So take that out first, as opposed to your tax-deferred stuff. If you have that same bond in a tax-deferred account, that same bond's earning 5% interest, but you're not taxed on it yet. You reinvest it, you let it grow, so your money can keep growing over time. Now, the downside is it's tax-deferred, it's not tax-free, but from this historical approach, this historical rule of thumb, it says that keep getting long-term growth as opposed to paying tax, because you're not paying tax on it yet. So deplete your regular brokerage first. Now, I don't personally agree with this. I'm just saying this is what you'll find online when you look up the order of withdrawals to take from accounts. And then finally, Roth has the highest net of tax growth because there is no tax if you let it sit and take it out, after you've held it 5 years and you're 59 and a half and whatever. Separate topic as well, Roth withdrawal rules. So anyway, that's the conventional logic. Don't get too hung up on that. I'm going to discuss tax efficient logic. So here we go. Now, this is where it's difficult because there is no single answer. Like I said, this is all going to depend on lots of things. Your own the amount of income you do or don't have already. The broad theme is you want to look for years where one of two things is happening. Your total income, your gross income now is lower than it will be in future years, and or tax rates themselves are lower than they will be in future years. So an example of number one, let's say you recently retired, your wages stop, they completely go away. You're only your late 50s, early 60s, so you have not yet started Social Security. If you have a pension, you have not yet started that. You're not 72, so you're not forced yet to take money out of your tax-deferred accounts. You effectively have zero income. Maybe you have some bank interest, some dividends, maybe some other, whatever, small noise. But for the most part, your gross income is rock bottom. And it's the lowest it's ever going to be in the rest of your life. Because once Social Security starts, boom, you have that income. It's not going away. When you have a pension, boom, when that starts, that's not going away for the rest of your life. When you hit 72, boom, you got to start taking out money from your tax-deferred accounts. So late 50s, early 60s, this is like the sweet spot, the tax planning window, whatever you want to call it, of low years of taxable income. So this is a good time to do some tax-efficient withdrawals, and I'll say, kind of specifically what. The other thing, part two, if tax rates now are lower than they will be in the future. We know now, this is fact, this isn't a political statement. Objectively speaking, federal tax rates are going up in 2026, if not sooner. This was all pre-scheduled as part of the Tax Cuts and Jobs Act that went into place in 2018. Federal tax rates were temporarily reduced. They were already set. It's already in the law that they will be going back up in 2026. Now, tax laws, like any law, it's always subject to change if legislators choose to change it. So that's why I say rates are going up in 2026, if not sooner, because I would venture to guess that there will be some sort of tax increase prior to 2026. Now, that's just speculation. I can't say it for fact, but at a minimum, taxes will be going up in 2026. And I have to believe they go up even further beyond that because this Tax Cuts and Jobs Act was put in place before the pandemic happened and before there were trillions of dollars of stimulus money created out of thin air. So what do you do in these low years of either low income and or low tax rates? A few things. You want to consciously give yourself more gross and taxable income in those years. Take advantage of being in low tax environment while you can. How can you take advantage of it? A few things. Do Roth conversions, right? Any dollar you convert from a traditional tax deferred account to a Roth account is included in your gross income and taxable income for that year. So take advantage of it while you're in these low income years, and or take distributions from your tax deferred accounts. Don't wait till you're 72 and the government tells you have to take them. Take them now. Like I said, give yourself more income now while you're in a low income environment and a low tax bracket, tax rate environment, and or sell some assets, some taxable assets at a gain. What do I mean by that? So you have a regular brokerage account. You have shares you bought 10 years ago that went up a lot in price. You're afraid to sell them because you're going to have a gain when you sell them. And that gain is going to be taxable in the year you do it. Guess what? If you're in this low tax planning window time of your life, low income and or low tax rates, now's a good time to give yourself some income. So maybe you do want to sell that position. And you don't have to use the money. So whether you take money out of tax deferred accounts that you don't need yet, you take it out just to fill up tax brackets, or you sell some assets that you still want to hold on to in your taxable account to consciously give yourself some more taxable income these years. If you don't need the cash from it, you can reinvest it, do something else with it, put it in a bank account, fill up your bucket one. If you're following along with that bucket thing. If it's like a stock you have in a brokerage account, you like the stock, you want to keep holding it, go out and rebuy it, right? What you're doing there is what's called resetting your basis. So you're selling it today, you're realizing a gain, you're paying tax on the gain for what you sold today. You can go the next day, rebuy that same stock, and then your gain going forward will be keyed off of the price you bought it at today. That's called resetting your basis. A little technical, but point is, if you're taking distributions or selling something you didn't want to sell, you can just reinvest. You can reuse that cash, but take advantage of your tax rates. All right, what do I mean by? And this is why. Here's the graphical depiction of why it's good to take advantage of these low tax years. So this is a little technical. Stick with me here, but hopefully this will make some sense. Here's a chart for 2021. This is just federal tax rates and respective income levels. Along the bottom is adjusted gross income. Along the left is your tax return filing status. Let's start with single. For 2021, you can have these numbers a little small. I had to really jam them in there to make them fit. You can have up to $12,550 of gross income, and none of it will be taxable federally. Why is that? Because you have a standard deduction. For anyone under 65, the standard deduction for a single person is $12,550 for 2021. Not to get too tax returny, but basically whatever your gross income is, subtract from it your standard deduction. The remainder is what's actually taxable. So if you have $12,550 of IRA withdrawals, for example, that would otherwise be taxable, subtract from it your $12,550 of standard deduction, you're left with zero taxable income. That's why I'm saying you can have $12,550 is taxed at zero federally. Next, above and beyond that, from $12,550 up to $22,500, any gross income there is only ultimately taxed at 10% federally. And look at my color coding here. So this green is super good, super green, because that's awesome, zero tax. This next one, still good, still green, but not as green. You have to pay 10% tax on all the dollars from $12,500 to $22,500. Above and beyond $22,500 up to $53,075, that's all taxed at only 12%. So for example, you stopped working, your wages went away, you have no other income. You didn't start Social Security yet, you didn't start pension yet, whatever. Don't let these low brackets go to waste. Consciously do Roth conversions and or pull money out of your tax deferred accounts, assuming you're over 59.5 and not subject to 10% penalty, or if you're younger and have one of the exceptions to it. Potentially sell things in your regular brokerage account to realize some gains. You want to give yourself at least $53,075 of gross income so as to not let these lower tax brackets go to waste. Fill them up, right? Don't just live off cash in these years, because cash, guess what? Cash isn't taxable. When you just take cash out of your savings account, that distribution is not taxable. So don't let these go to waste. Give yourself income, taxable income to fill these buckets up, at least up to 12%. Above and beyond that, this is now yellowish. $3,000 and change up to 98, almost 99,000 bucks. That's all taxed at 22%. So we start getting higher now. 22%, not awesome, but not necessarily horrible. And then above and beyond that, it's 24%, and then it keeps going all the way up to 37 eventually. Now, a lot of this is sort of educated guesswork. We don't know how high taxes are going to get in the future. Some people feel taxes are going to double. I personally think that's a bit of fear mongering. But if you do firmly feel taxes will double, well, then guess what? Yeah, you're going to go nuts filling up these buckets. Definitely the 10 and the 12, maybe even 22, maybe even 24. Because who knows? If you think you're going to be in the 30 or 40 something % tax bracket in the future, sure, fill these up now. I don't know where taxes are going to go or how high. I don't think they're going to double. But they will go up. How much? Nobody knows, but they will be higher than they are today. I can tell you that much. Okay, just quickly for married folks, just to show the numbers here. So if you're married and file a joint return, here's where all these thresholds are. The standard deductions double for married folks. So that basically means you can have up to $25,000 and change in gross income, and it'll all be effectively taxed at zero because your standard deduction wipes it away. Then you can have from 25,000 and change up to 45,000 taxed at 10, and then up to 106 taxed at 12, and then your 22 starts, etc. All right, I just got very numbersy, very technical. Sorry for that, but this is the best way to show why you are in a good tax opportunity environment when you're in low income years and or low tax rate years, which is typically for early retirees, late 50s, early 60s. Again, before Social Security starts, before pension starts, before required minimum distributions start. And now, while we're in this historically low federal tax environment under the Tax Cuts and Jobs Act, we got low tax rates for hopefully the next few years. Okay, so this is why I'm saying the conventional logic that says take cash, then taxable assets, then IRAs, then Roths. No, not necessarily, because I'm saying depending on your tax bracket, your other income, no, you want to take more higher taxed income now, like traditional IRA distributions, while you're in these low tax brackets, while we know federal tax rates are low and will only be going higher in the future. Front load some of your distributions from those accounts to fill up these lower buckets. Don't just let it sit there forever and keep kicking that tax can down the road. Pay some of it now, get it out of the way, so you'll avoid some of whatever the eventual tax increases will be in the future. And depending how cute you want to get with slicing and dicing, like if you want to top out right at the 12% bucket. So for example, and this is why this distribution stuff gets complicated. So let's assume you didn't want to go over the 12% bucket. Let's assume you have a pension that's $22,500 coincidentally. So that fills up these two. So your pension already crowds out your standard deduction and this 10. So any other income, taxable income you have will be taxed at 12% at least. So maybe then you pull out about 30,000 bucks from your IRA. That then fills up your 12. But guess what? Maybe you need another 20 grand to live on. Where do you get it from? Well, then you can start tapping cash if you want, or even taking out Roth money, because keep in mind, cash isn't a taxable distribution if you're taking it out of a regular bank account or something. And Roths aren't taxable, assuming you meet the conditions for it to be qualified. So if you don't want to exceed 12%, you'd fill up taxable, gross income up to here, and then any income needs you have above and beyond, now you're just taking cash or Roth assets, which aren't taxable and don't put you into the 22. So year by year, it takes some planning and massaging and figuring out, okay, how much do I want to fill up? What's my income going to be? How much do I tack on top of it? What are the tax rates this year? There's a lot of moving parts, which is why this gets convoluted. And some people are just like, forget it. I'm just going to live my life. And I can't knock you for that, because this can get unnecessarily technical. Some people love this stuff and make this their passion to do this and spend retirement, tweaking this to stick it to Uncle Sam in every way possible. Some people are like, I just don't want to bother. It's too much headache. I just want to do my thing. So before questions, I got one final slide. Let me just wrap with this, and then I'll come back to whatever. So other considerations. I made it look, now I'm sure a lot of you, your eyes glazed over when you saw this. Apologies, but I felt there's no other way to show this than in this graph. I made it sound pretty simple, relatively simple. Like pull out money from IRAs, do Roth conversions, fill up these green buckets here. Whether or not you fill up these yellows, that's kind of up to you and what how firm your conviction is about the severity of future tax increases. There's other things to consider. It's not this simple. For example, if you left work, you're not yet 65, so you can't start Medicare, and you get health care through the exchange, ACA, Affordable Care Act, you could be eligible for potentially very large subsidies / credits, tax credits on your ACA insurance if you can keep your AGI or Maggie. So this is adjusted gross income or modified adjusted gross income. Discussed the particulars of these in separate videos. If you can keep it really low, 1 to 2 times the federal poverty level, which is only, depending if you're single or married, it's like from $12,000 to $34,000, this 1 to 2 times federal poverty level. If you can keep your AGI, your gross income really low, you can get a lot, potentially thousands of dollars a year in subsidies on your health insurance. So that now flies in the face of this. So this chart would tell you, pull out, up to $53,000 in IRA withdrawals to fill up this bucket. Well, that contradicts this. If you're on ACA insurance and you're able to keep your AGI really low, potentially $10,000, $20,000, it may be worth it to do that, to really squeeze as much as possible out of the subsidies, as opposed to instead filling up these tax buckets. So that's a super technical thing beyond the scope of tonight. But the point is, that's why it's not as simple as just always simply fill up these buckets, because there's other things to consider that may apply to you. One other thing, if you're 63 or older, you need to start being mindful of your gross income, because Medicare premium surcharges are keyed off of your gross income. For this year, to the extent your gross income is over $88,000 if you're single, or $176 if you're married and file a joint return, you will start needing to pay additional premiums on top of the base Medicare premiums. So when you're on your quest to fill up your buckets, for example, like if you're single and you want to fill up your 22% bucket, this is going to put you in that Medicare premium zone once you get over $88,000. So if you're trying to avoid these Medicare surcharges, you may want to stop like here at $88,000 and not fill up here. So there's moving parts to this. Legacy goals. If you know you're going to die with a lot of money and you know you plan on leaving it to charity, for example, it would be good to leave them your tax deferred accounts like your IRAs and 401ks, because charities don't pay tax. So don't feel the need to have to spend down or distribute this tax deferred money to fill up these buckets if you know you're just going to leave it all to charity anyway, because charities skip taxes. So that's another reason. That's another thing to consider when doing these withdrawals, is like your legacy goals. And same thing if you leave money to heirs, and if they're in low tax brackets, they don't make a lot of money or whatever. It may not be it could be a pretty good idea to leave them some of your tax deferred assets, let them pay the tax on it if they're going to be in low tax rates. So a lot of things to consider. And finally, I'm sure a lot of you are like, man, forget this, I'm done. Enjoy life. Try not to worry about all this mess too much. As you can see, can be really complicated, really technical. There isn't necessarily a right answer. You can drive yourself bonkers trying to optimize and tweak this stuff year to year. Some people love it. typically, not to stereotype, like engineers are really into this stuff, and math-minded folks. Some people are like, I don't even know what you're saying right now. Forget. This is just, worrying about this is making me lose sleep. I don't want to do it. I just want to be happy, die, whatever happens, happens. Fine. That could be the right answer for you. So, apologies for the whole point of this group is tax efficiency and talking about the technical taxy things about retirement. I'm partly to blame for making it sound like everyone needs to do all this stuff and be super attuned to it. Maybe you do, maybe you don't. It's up to you. Again, if you just want to live your life, taxes are going to be what they're going to be. It's more worth it to not have to worry about this crap. Good for you. That's the right answer for you. Other people will sweat every single penny and want to really, squeeze everything out the ringer as much as possible with taxes. Then you're super into this stuff. Most people are kind of somewhere in between. Not sure I'm going with that. But I realize tonight's topic is one of the more overwhelming ones, one of the more complicated ones. So if this is too much, you feel overwhelmed, not your fault. Don't worry about it. This is definitely one of the more complicated things that we've touched on. All right, I'll leave. That's my formal presentation. Again, sorry for making everything super, super technical and complicated, but that's kind of the point of the group. I try to make it as digestible as possible, but there are times where it's just like, oh man, what is all this nonsense this guy's talking about? Okay. Let me get a drink here and then I will do questions. And I'm back. Oh, geez, I don't even know where to start with these questions. All right. Let me just scroll up to the top here and kind of see if I can pick up where I left off. Oof, man. Yeah, so as I mentioned before, how do the different account types fit into these buckets? They don't fit into it neatly, honestly, which is why the buckets are like too unwieldy to actually do in practice, in my opinion, because it's a combination of withdrawing from different account types, withdrawing cash versus stocks versus bonds. So there really isn't a clean way to meld the idea of different account types with 3 different buckets, because buckets are purely just time segmented withdrawal needs. These account types are sort of like opportunistically take from certain account types when you're in low tax years and things like that. So that it doesn't jive well with the time idea of buckets and the taxability idea of account types. So not a great solution to this one, to this question, unfortunately. Yeah. So the downside of a balanced fund again is one fund that has a combination of stocks and bonds is no, you can't pick and choose where you sell from. If you just sell X amount of shares of your balanced fund, you're selling stock and bond at the same time. That's why I don't personally use balanced funds. I use super simple portfolios personally and professionally, 3 to 5 ETFs that collectively cover thousands of individual positions. That's all you really need. But a balanced fund, while it's perfect while you're accumulating, right? You can literally do a set it and forget it target date retirement fund. The downside is when you do start distributing, balanced funds don't work well because you can't pick and choose whether you sell stocks or bonds because you sell a bit of everything. So that's why I break it out and use a few funds. They effectively replicate a balanced fund, honestly, because that's all people really need in terms of simplicity. But you need to have the control over which do you sell stocks, do you sell bonds. So that's why I don't use balanced funds in a distribution stage of life, because it doesn't really work. I'm just looking here. Okay, there's a Roth withdrawal question kind of outside the scope of this. Someone commented on balanced funds. Thank you. Someone else said, yeah, okay. Balanced fund, you can't pick and choose whether you sell stocks or bonds. If you get a monthly pension in addition to Social Security and other accounts, can you count the pension as part of bucket 1 because it's fairly secure, or no, because there's always a chance it goes away? Great question, but no. So these buckets and tonight's whole presentation was only in reference to withdrawing from your investable assets. So that's withdrawals on top of the lifetime secure stable income you already have, Social Security, pensions, and any annuities that are annuitized and throwing off income. So go back to the example of you need $100,000 every year, and you have 60,000 of pension and Social Security. So that right there, that covers the first 60 grand. So it's only the 40 grand that you need to withdraw from your portfolio that tonight's topic talked about. So you know you're going to need to pull out 40 grand this year. You know you're going to need to pull out 40 grand next year. Those first couple of years, you're going to want that in cash or something really safe. And so that's on top of your pension. Now, the other extreme example was if you only have a $40,000 total annual spending needs and you have $50,000 of pension and Social Security, you don't have any of these bucket issues because you already have more money than you need coming in every month. So you can, disregard everything we did tonight because you don't really have to worry about any sort of systematized withdrawals from your portfolios. You'll just kind of take money as you need it because you already have more money than you need coming in from pension, Social Security, or annuity. Okay. Yeah, so just looking here, target date funds. Here we go. Slightly off topic, but I did touch on it before. So now I'm 59, will be retiring within a few months, so I will need ACA, Affordable Care Act, for health insurance. Should I use Roth funds initially so my income will be low zero? I can't tell you what you should do. I can't tell you what's best for you, unfortunately. But should you choose to go the route of keeping your income really low for purposes of maximizing how much credit you're eligible for, yes, Roth withdrawals is one option to do that. Living off just cash, cash in your savings accounts, another option. Using home equity even, or any sort of loan for that matter. If you have home equity, you can tap. That's a loan, you're borrowing. It's not free money by any means. I'm not saying it is. But the proceeds you take out as a loan aren't taxable income to you. So that you can use that as a bridge perhaps for a few years until you get Medicare and then eventually pay the loan off. Loans from home equity loans aren't taxable income. To the extent you have a cash value life insurance you can borrow against, loans against that aren't income either. It's a loan, it's borrowed money. So those are all ways you can get yourself some cash flow without it being taxable or only minimally taxable. But I can't tell you should do that. I'm just saying if you wanted to, those are the options of how to get low tax or zero tax sources of cash flow into your hands while you're trying to maximize ACA credits. Would you want to pull from Roth earlier if you are concerned about getting pushed into a higher tax bracket by withdrawing from a brokerage account or traditional IRA first? I don't know. I mean, I guess, yes. If you already have other income that drives up your tax bracket on top of traditional IRA or brokerage, then yes. I mean, like I just said, pulling out of Roth or living off cash or taking loans from your house or from a cash value life insurance policy, those are all generally non-taxable sources of cash flow. So if you are trying to avoid creeping up the tax brackets, then yes, Roth withdrawal would be one way to get there. Again, I'm not recommending you do that. This all comes down to do you want to pay taxes now or taxes in the future? If your goal is to pay taxes in the future, then sure, then I guess you want to minimize your taxable income now. But I think the opposite should generally be true. We know we're in a low tax environment now. We know taxes are going up. So all else equal, you may want to consider paying more taxes now as opposed to taxes in the future. Okay, so tax deferred accounts have required minimum distribution, so wouldn't they be the second withdrawal? If you're 72 or older, yeah, a certain amount of money has to come out. In the year you're 72, it's about 3.9% of your tax deferred balances. So yes, you can't avoid it at that point. Now, maybe your RMDs don't cover your full income needs, so then you revert back to taking out of other places. But yes, once you hit 72, RMDs need to happen from your own tax deferred accounts. Okay, let's see. Ooh, kind of random, but maybe this fits in. Can you talk about NUA or net unrealized appreciation? Yeah, did a video on this. It's a fairly technical topic, but NUA is if you have an employer plan like a 401k and you have company stock of that employer in that plan. When you eventually leave and take money, distribute out your plan and roll it over somewhere, you can take the company stock that's in there, move that to a regular brokerage account, and then roll over the rest of the money to a tax-deferred account like an IRA. In moving the company stock to a regular brokerage account, you pay tax on it in the year you do it, but you only pay tax on the amount of what the stock was worth when you first bought it or when it was first given to you within the account. So yes, you can use NUA and however much income it's going to generate in the year you do it as part of what fills up your those lower tax brackets in your relatively low years of income. Again, before Social Security, before pensions, whatever. So that's another option to consciously give yourself some income in a certain year. I'll leave that one there because NUA can go down a big rabbit hole. Okay. What else we got here? Here's a question. So we mentioned if you have stocks or any asset in a regular brokerage account and you sell it and it's at a gain and you consciously sell it to recognize some gain, like in one of these low tax years, can you rebuy it the same day when resetting the basis? Yes, you can. So you bought it at 5, you sold it at 20 today. You have a $15 gain. As soon as you sell it, you can immediately turn around and rebuy it back at $20. So now going forward, any gains or losses will be keyed off of today's $20 new purchase price. Now, if you do eventually have a loss after you rebuy into it, you got to watch out for a wash sale rule, separate topic. I got videos on that. Long story short, you can't recognize a loss. You can't recognize selling something at a loss if you had bought that same security 30 days prior or 30 days after. So be careful with that. But otherwise, if you're buying to hold for the long term, yeah, you can sell it, recognize your gain today, immediately rebuy it, and just sit on it again for however long. Yep, that's called resetting your basis. During these really low income years, are you able to take the saver's credit deduction? Maybe you have a small amount of earned income where you could contribute to a retirement account. Oh, that's a good question. I don't know, Jackie. And frankly, I forget what the saver's credit was. I know it was something if you have a low enough income and you contribute to an IRA, you get an extra credit or something. I'd have to look that up. I don't remember enough about it, but sorry, I'm completely useless on this question, but good question. Okay. Who's this? Cody Garrett. I don't know if this is someone asking a question to Cody Garrett. This is Cody asking, but Roth withdrawals aren't counted against ACA subsidies, right? Correct. They're not, assuming they're qualified. Qualified, typically you're 59 and a half or older, and your first Roth account is 5 years or older. Has been around and funded at least 5 years. Yes, qualified Roth withdrawals are not included in your AGA for ACA credits. A non-qualified withdrawal, if you take it out early or prematurely, some or all of that may be included in your gross income and therefore can be counted against you for ACA subsidies. Are my eyes blurry? I know mine are from looking at all this nonsense tonight. Can't see the chart. Yeah, sorry. I had, there's a lot jammed in there. I realized after I was making it, like, wow, there's a lot of stuff here. So apologies if it doesn't show up well, especially if you're looking at a post this big on the Facebook screen. If you look at the replay on YouTube, you'll be able to blow it up full screen and the chart will, it won't be as small. Apologies for that. Sloppy planning and making it on my part. I forgot that the presentation's this big when you all are looking at it on Facebook, or even smaller if you're looking on your phones. Frog, thanks. I don't know what that means, but I like it. Okay. I can see the number of attendees is slowly ticking down below 200, so I'm losing people here because I'm pulling up pictures of a frog and saying frog. Thank you for those that are still around. I'll keep going through questions. All right, getting started caught up in my questions from 20 minutes ago now. So yeah, someone asked a question about resetting basis. Oh, someone likes my slides. Thank you. Filling up the lower brackets. So kind. Uh, what is the top AGI before that happens? Not sure what you're referring to. I guess possibly Irma, the Medicare surcharges for single folks. It's $88,000 this year. It's $176,000 for married folks, and that ticks up a little bit year by year. Just seeing what other comments we got here. I don't know what this means. How does converting Anita funds to Roth work at 75? Don't know what Anita funds are, unless someone answered it elsewhere down in the questions that I'm not seeing. Harder to plan than to leave. Yeah. Yeah. I want to die with nothing. I find it harder to plan than to leave some. Yeah, it is. Again, tell me with certainty when you're going to die and what the stock and bond markets are going to do and how much you need to spend every day for the rest of your life. And I will tell you precisely how to die with nothing. That's why it's a moving target, and you don't want to shortchange yourself and get there too soon and die with nothing too fast. That's why it's good to maximize Social Security, maximize pension. For those that are married, not just for you, but for whichever one of you eventually outlives the other, so that if and when you do deplete your portfolio, at least Social Security and or pension and or annuity, if you have one, are still there for you. If you own a home, you maybe have home equity left as well, so you can potentially tap that in a pinch in your older years. So yeah, like build a foundation of sizable amounts of lifetime secure income, and then the rest of it's kind of fun money. Not all of it, but not necessarily the end of the world if your portfolio depletes. If you still have a healthy amount of Social Security and pension, that'll be there forever. Yeah, that's a good one. HSAs, health savings accounts, are good to leave to charity. They're good to leave to spouses and charities, and that's it. If you leave it to anybody else, they're fully taxable in that person's hands in the year they inherit it. So HSAs are great long-term savings tools, horrible wealth transfer tools, unless you leave it to a spouse or you give it to a charity. Oh, here's a good one. What is the best way to predict the future value of your accounts? Pretend this is a crystal ball. I don't know. Impossible. So doesn't mean you shouldn't try. You use history as a starting point. But again, the past isn't guarantee of future results. So stock market's been on a tear the last 10 years. Is it going to last? I can't imagine it keeps up at this pace forever. I would assume there's going to be some sizable pullback at some point, but I've been saying this for a few years. And I've been around since, so I don't try to time the market. I just make sure people are allocated and invested accordingly for their needs, their wants, their risk tolerance, and whatever the financial markets may throw their way. There's probability-based approaches called like Monte Carlo that basically looks at the portfolio you currently have, looks at how they've interacted with one another historically, looks at how they've each, what kind of returns they've each had historically, and runs potentially thousands of different scenarios of what's all statistically possible outcomes in the future for this portfolio. Again, based on the past, that's the downside. What are statistically possible outcomes of this portfolio over the course of 30 years, 40 years, whatever. And it'll give a range of here's like the statistically highest possible amount you'll end up with, the statistically lowest amount you'd end up with, and then all sorts of things in between. That's really kind of the best way to try to put any sort of educated guess as to what your portfolio may do in the future. But again, it's all just guessing, right? With statistics and math and history on its side, but nonetheless, nobody knows. Anyone who claims they do is absolutely fooling themselves. Now, as I mentioned early on in this thing, at one extreme, if you want to get rid of all variability, any ups, downs, whatever in the stock market, bond market, you can. You can take every single dollar you have and just buy an annuity with it. An annuity in its purest form is just a pension. You're buying yourself a pension from an insurance company. You hand over a lump sum of money. They agree to give you some monthly payment for the rest of your life. Done. 100% certainty, unless the insurer goes bankrupt. But if you pick a good established insurer, the chances of that are slim to none. I can't say none, super, super slim. So I wouldn't be worried about that. But yeah, if you wanted to, just take every single dollar of investable assets you have, just buy annuities out the wazoo. So you know exactly what you're going to get. Now, the downside is, what if you live a really long time and there's massive amounts of inflation and your annuity is just this fixed payment? You may eventually end up having more income needs than your annuity provides. Whereas if you're invested well and you have some exposure to stocks and whatever, stocks generally do well when inflation goes high, when inflation goes up. So like having some stock exposure is an inflation hedge, if you will, to give you that growth when inflation goes up. So, and just to give you some numbers, for example, I looked this up the other day. If you're in your early 60s and you have average assumed life expectancy, so mid 80s or whatever, and you take $100,000 and you buy what's called a single premium immediate annuity, meaning that's where you give an insurance company $100,000, they give you a payment for life starting today. If you're in your early 60s, you can get maybe $450 a month for the rest of your life on $100,000 of initial purchase. So do the math, right? That's not a lot of money, $400 a month. Now, granted, that'll be on top of Social Security pension if you have one, but even if you plopped $1 million into an annuity right now, and you get $450 a month times 10, that's only $4,500. Not only, but it's $4,500 a month for the rest of your life. You'd get an annuity income for taking $1 million and irrevocably giving it to an insurance company today. You'd get, maybe 55 grand a year. Now it's not going to have any inflation increase. So 30 years from now, you'll still only be getting 55 grand a year from that annuity. If you die along the way, those payments stop. Now, if you want a feature to continue on payments for a spouse or someone else, you can do that, but your payment's going to be even lower. So now you're down to maybe 40 grand a year only. And this is on $1 million of initial purchase. So it just goes to show how I don't want to say annuities are expensive. It's a function of interest rates, but like how much money it takes to pay for the guarantee and consistency of buying yourself a private pension in the form of an annuity. It takes a lot of money to buy yourself a lot of pension through an annuity. So that's why I'm saying it's not really feasible to go the extreme route of just taking all your money, buying an annuity, and never having to worry about the stock market again. Because interest rates are way too low and it'll cost you way too much money to buy any sort of meaningful amount of annuity income today. How did I even get on that? Oh, right. So about this, like, if you're concerned about predicting the future and you don't want to see things go down, you can just buy a bunch of annuities, but you're not going to get a lot of bang for your buck with annuities. That's the price you pay for the certainty and stability of annuity income. Thank you, person, whoever this was. Okay, what else we got? Oh, this is a good one. Not related to tonight, really, but relevant to a lot of people. When you retire, can you petition Medicare to reduce payments instead of accepting higher payments based on income 2 years ago? Yes, under 8 circumstances. So, Irma, we have videos on this. I've done lives on this. Again, that's the additional premiums you have to pay for Medicare on top of the base premium if your gross income is above a certain level. It's basically means testing, for plain and simple, based on high incomes means, not assets. It's income, not assets they look at. So common scenario is you're 60, you stop work. Let's fast forward a little bit. You're 65, you stop working. You're making 200 grand in your final year of work. You stop working, you start Medicare the next day. Your Medicare premiums 2 years from now are based off your income from 2 years prior. So in 2 years, you're going to look and say, hey, you made 200 grand of income. That puts you well into Medicare premium surcharge territory. You're now paying, another $100, $200 a month for Medicare. Haha, joke's on you. Well, you're going to say, well, that's not fair. I retired. Yes, I made 200 grand 2 years ago, but I'm not now. I'm making 40 grand now in Social Security. You can get that reassessed. that retirement is one of the 8 life-changing events where you can say to Medicare, hey, yes, my income was high 2 years ago. That's not indicative of what it's going to be going forward because I've since retired. Those wages went away. So yes, there's a form called SSA 44. Google it. It's fairly straightforward. I've done it a few times for people. Yes, it works. Now, Roth conversions, if you do a Roth conversion and that spikes your income 1 year, you cannot get a waiver of Medicare premium surcharges because you did a Roth conversion. That's not one of the qualifying events. The qualifying events are retirement, change in marital status. You got married, you got divorced. You got a one-time like legal settlement that spiked your income, things like that. Not conscious like selling a stock or doing a Roth conversion. Those things aren't eligible for this waiver of premiums. A good question, whoever this was. Here's I like that. This should be on a t-shirt. I don't have an issue with spending after saving my whole life. My issue is paying taxes. Damn right. Okay. All right. What else we got here? Oh, man. Sorry, I'm just scrolling through comments here. I hate sitting here with dead sound where you all look at me, look off the side of my screen, but I'm just trying to skim through comments before I just pop up anyone, before I just pop up the first one I see. Okay, I don't know what this says. Let's take a look. If you are single, how do you determine if you get a pension? Oh, if you are single, how do you decide if you take a pension versus a lump sum, I guess? Yeah, good one. I did a video on that. I'm not just saying this to plug my YouTube channel. I intentionally created videos that were common questions people have, and one of which is like pension versus lump sum. So if you go to oh, okay. So I should scroll down. Someone shared a link. I don't know if this is the one. Could be. But yeah, I did a video on how to decide between a pension versus a lump sum. That'll give you all the things to consider. There's one thing I left out mistakenly after the fact I realized, and it's only specific to federal employees. Like if you get a federal pension and you... Oh, well, I'm speaking of federal. So next week's topic, I have a special guest, Casey Madsen, specializes in federal retiree issues, benefits, healthcare, the TSP plan, whatever. He's going to be on next week talking all about federal stuff. So issues specific to federal retirees or people retiring from federal work. Definitely going to be a good one, especially if you or someone you know is or was a federal employee. So again, Casey Madsen next week, special guest. So anyway, so yeah, one of the things I left out, my pension versus lump sum thing, was specific to federal pension. You have an option to take a lump sum from your federal pension. If you do, I believe you then give up the ability to continue your federal health care up until Medicare, something like that. Whereas if you take the annuity option, then you can continue keeping your federal health care. You're paying for it, but keeping federal health care through Medicare. So that's one wrinkle that if and when I redo that video, pension versus lump sum, I'll add that in, but that's specific to federal. And I'll make sure Casey talks about that next week. I feel like I just botched it and didn't do it justice, but that's one thing to consider. What else we got? Buying an annuity in today's market is probably the worst thing to do. Yeah, it is and it isn't. Interest rates being painfully low means you'll get painfully low payouts for a given amount of dollars you give to an insurance company to buy an annuity. The flip side is if you need an annuity, like you're building out your income plan and your Social Security or pension are really low, you may want to still consider an annuity. Like don't try to time the markets or the interest rate environment. If you need guaranteed, secure, stable lifetime income and you're not getting enough through pension or Social Security, and annuity is your only other option. You know, Social Security, pension, annuity, the only 3 things that will give stable, guaranteed lifetime income. So if you need it, you need it. You're kind of at the mercy of interest rates. And if that means you have to buy it today at stupidly low interest rates, then so be it. But yes, ideally, if you could wait and hope interest rates increase, then great. But what if they don't? What if we're in this low interest rate environment for 10 years? Or what if they even go down again? You know, so we're starting to talk about market timing now of interest rates. Now, I saw someone comment before dividends. are dividends or even bond interest, I guess. Can you consider that like your stable, secure lifetime income? Sort of, but no. To be stable and secure, it needs to be guaranteed amount, a known amount that won't fluctuate. If anything, it'll go up with inflation, but it won't go down. It won't run out. It can't be just randomly turned off. So if you have dividends, a company can decide to stop paying dividends, or they can decide to reduce dividends, or they can decide to pay them less frequently. Now, true, there are companies that have historically paid rock steady dividends every quarter on the nose with consistent increases. That's why I say sort of, but that can always stop. If there's an end of the world type scenario for that company and they go out of business, or they end up being a fraud or bankrupt or whatever, that dividend goes away or gets cut substantially. So I wouldn't rely on that as always being there. Again, it may be historically, but it could go away. Same thing with bond interest. The bond issuer could default and your interest stops. There goes your interest. Now, Social Security, a lot of people will roll their eyes at this, and I get where you're coming from. It can be changed anytime by the government, right? It's a social welfare. I'm not saying welfare in the demeaning way. It's a social welfare program. You're not obligated. You're not entitled to always get this, period. This is a social program that can be changed. But I feel, just my opinion, anyone who's already on Social Security or close to it, so late 50s, early 60s and above, I can't possibly fathom a scenario where they actually reduce Social Security payments for anyone. I think more of it will be taxable. I think there may be other sort of ancillary tweaks they do to it, like if you work while getting Social Security, they may ding you a little bit. If you work beyond your full retirement age, they may ding you. They already ding you if you work below your full retirement age. And I think they're gonna ding people like me, 40s and younger, may get their benefits eventually reduced, but I can't see them taking benefits out of people's hands who are already on it. So that's why I think Social Security, if you're already on it or close to it, that's not getting decreased for you. Anyway, and like I said about annuities, if you get an annuity from a well-rated insurer that's been around 100 years through the Depression, through the financial crisis, whatever, I can't picture them going away. Plus, there's government backstop insurance funds to kick in if and when an insurer does actually go belly up. But yeah, interest rates are painfully low. Whoever posted this. Oh man, I'm running out of voice here. All right, I think we're done here. Actually, there's only one more comment if I'm looking at this right. Oh, here we go. Here's a federal one. In order to continue the federal employee health benefit insurance, you must take a survivor benefit at either 25 or 50% per federal pension. There is no lump sum amount available. Right. Thank you. That's what I was trying to get at. So right, if you want to continue on your health insurance as a retiree, your federal health insurance as a retiree from the federal government, you need to select one of the pension annuity options. You can't take the lump sum, or if you do, you forego the ability to continue on the federal health insurance. Okay. All right. Looks like we're done with comments here. So thank you all for the 152 people who are surprisingly still looking at this. Good for you. Thank you. I appreciate it. So I will wrap here. Again, thank you for sticking along. I know this was super thick and technical, and probably the most difficult one to follow of all these lives that I've done, but hopefully you got a lot out of it, or at least something out of it. And definitely next week, Casey Madsen, all about federal benefits. That'll be a good one. Hope to see you then. Otherwise, take care, and I will see you in the group throughout the week. Have a good night.